Volatility is one of the least understood and yet most important concepts in option trading. Before you can appreciate how to use volatility, you first have to understand what volatility is. While discussing volatility in this video, I'm going to be speaking specifically about volatility of equities, but the concepts apply to any financial instrument. Well, to define it simply, volatility is movement. In financial markets, we typically talk about three different types of volatility: historic, forecast, and implied. Historic volatility is how much movement a stock has experienced in the past. We can calculate historic volatility by looking at past stock prices and then calculate the average deviation from the mean price over a given period. Historic volatility is not technically part of the option pricing model, but most people base their volatility input to the pricing model, at least in part, on the historic volatility of the underlying asset. Forecast volatility is your personal outlook. It's how much movement you expect a stock to have in the future. How you come up with that number is entirely up to you, but as we'll demonstrate, it's one of the most important pieces of option trading. In fact, you could say that differences in opinion about forecast volatility is the single most important driver of option markets. The final type of volatility, implied volatility, is the volatility that most option traders are talking about when they use the term volatility. To give it a definition, implied volatility is the market consensus of forecast volatility. Another way to look at it is that an options price is the midpoint of supply and demand in the market. Supply and demand is driven by traders' forecast volatility, and therefore implied volatility could be defined as the midpoint of forecast volatility. Allow me to illustrate this concept through an example. In this example, there's a stock that's trading for $50 per share. We have a call option with a strike price of $45, and this call has an asking price of $8 per share. Now, by way of review, for a call buyer to break even or better on this option at expiration, the stock needs to be trading for at least $53 per share. Trader A is considering whether to purchase this call or not. Through their analysis, Trader A thinks the stock is going to increase in value to $55 per share by the option's expiration date. Should Trader A purchase this call? The answer is absolutely. Trader A could purchase that contract now for $8, and it would have an intrinsic value of $10 at expiration, netting them a nice profit. Trader B is also considering placing a trade on this call. Trader B agrees with Trader A that this stock is likely to go up between now and expiration. However, Trader B only expects the stock to go up to $51 per share. Should Trader B buy the call? The answer is absolutely not. If Trader B bought the call and ended up being right about what they expected, they would lose money. So what does Trader B do? Trader B, thinking that the option is overpriced, sells it to Trader A. Trader A, thinking that they're getting a good deal, is happy to pay the price. Who's right? No, we won't know until time goes by. But this is a basic, simple illustration of how the option market functions. Well, let's look closer at this example. The two traders, they agreed on almost everything contained in the option pricing formula. They agree that right now the stock's trading for $50. They agree the strike price of the call is $45. They agree on an expiration date. They agree on dividends and interest rates. They even agree with each other that the stock is most likely going to go up. In fact, the only thing they disagree on is volatility. Without these disagreements about volatility, the option market wouldn't function. Volatility is what drives the option market. We're going to go a lot deeper into understanding volatility in future videos. But in addition to how important volatility, there's one more thing about volatility that we need to recognize from the example we just discussed. Volatility has a major impact on option premiums. higher volatility levels imply a higher level of expected movement, and lower volatility levels imply a lower level of expected movement, hence the term implied volatility. If more movement is expected, option premiums increase. If less movement is expected, option premiums decrease. Trader A, in our example, was expecting more movement and so was willing to pay more for the option than Trader B. Trader B wasn't expecting as much movement and so was not willing to pay the premium that the market implied volatility had set. Understanding volatility is critical to understanding options.